induced changes in input prices. Inflationary gap means actual GDP is more than the potential GDP, which implies excess demand for inputs. It raises input prices faster than the input productivity. Similarly, recessionary gap means actual GDP is less than the potential GDP, implying less demand for inputs and fall in input prices. Have conditions of input price change. 1. When actual output is more than the potential output, the resulting gap is inflationary in nature. Second, when actual output is less than potential output, the resulting gap is deflationary in nature. Third, when actual output is equal to potential output, wage rate increases at the same rate as productivity. There is neither overutilization nor underutilization of the production capacity. Third, impact of long run aggregate demand shocks. Expansionary aggregate demand shock in the long run works as an adjustment mechanism for equalizing actual and potential GDP of the economy and eliminates the resulting inflationary gap. Contractionary aggregate demand shock, on the other hand, eliminates the recessionary gap. अब asymmetrical adjustment mechanism. Expansionary demand shock eliminates the inflationary gap faster than the elimination of recessionary gap through contractionary demand shock. अब ways to increase GDP level. पहला increase in aggregate demand, second है temporary increase in aggregate supply, third है permanent increase in aggregate supply. अब economic growth, it is a process of continuous and sustainable increase in the potential GDP over a long period of time. A business cycle, it refers to fluctuation of actual GDP around the potential GDP of the economy. It is a short run economic phenomena occurring due to aggregate demand shocks and aggregate supply shocks. A discretionary fiscal stabilization policy, correctional measures undertaken by the government for fiscal stabilization are known as discretionary fiscal stabilization policy. Fine tuning, it refers to elimination of fluctuation in the private sector expenditure through fiscal policy so that actual GDP of the economy is equal to the potential GDP. Gross tuning, it refers to the occasional use of fiscal policy to remove large and persistent GDP gaps. Limitation of discretionary fiscal policy, यह है information lag referring to time lag between collection of information and application of fiscal measures for correcting a situation of economic stability. Second, a decision lag referring to time lag between policy decision and its implementation. Third, a execution lag referring to time lag between decision taken by government and its execution. Auto stabilization. Stabilization of the economy through the usual taxing and spending behavior of the government is known as auto stabilization. Money, it is that part of person's wealth which can be readily used for purchasing goods and services. Characteristics of money: first, a liquid asset; second, a general acceptability; third, a voluntary acceptability; fourth, a medium of exchange; fifth, it is a means not an end. फॉर्म्स ऑफ मनी, पहले कॉमोडिटी मनी, दूसरा मेटेलिक मनी, तीसरा पेपर मनी, चौथा है बैंक डिपॉजिट्स और बैंक मनी. माइलिंग, it was a method of minting the metallic coins with a rough edge to avoid the breakage of coin. अब Gresham's law, bad money drives out good money from the economy. ठीक है. अब लीगल टेंडर, it is anything that law must be accepted when offered either for purchase of goods or services or for discharge a debt. Fiat money is the money that can't be redeemed for anything other than replica of itself. As a medium of exchange, fiat money is backed up by the authority of government. Fractionally backed paper money, when assets of the note is issuing bank is less than the claims in the form of paper money, it is known as fractionally backed paper money. Currency debasement, it refers to reduction of intrinsic value or metal content of a currency through reminting. Global money, it is the money which is widely accepted as a medium of exchange throughout the world. American dollar exhibits this feature. Composite money, it is that money which reflects average value of the various currencies of a group of nations, for example euro. Real assets, it includes physical assets like houses, land, machines, metals, etc. Financial assets, it refers to claims against physical wealth. अबे near money, it refers to those assets which can't be used immediately to buy goods and services but which can be converted into money very easily and without any loss in their value. अबे assets treated as near money, टाइम और फिक्स डिपॉजिट्स पहला है, दूसरा बिल्स ऑफ एक्सचेंज, तीसरा ट्रेजरी बिल्स, चौथा बॉन्ड्स, पांचवा शेयर्स, छठा है पॉलिसीज ऑफ लाइफ इंश्योरेंस कंपनीज एंड यूनिट्स. अबे quasi money, it refers to those financial assets which have some of the attributes of money and fulfills some of its functions but not well enough to be considered as money. Example, postal order, gift vouchers, etc. अबे डिफिकल्टीज ऑफ बार्टर सिस्टम, पहला लैक ऑफ डबल कॉन्फिडेंस ऑफ बॉन्ड्स, सेकंड है नो कॉमन यूनिट ऑफ वैल्यू, थर्ड है इनविजिबिलिटी ऑफ सर्टेन गुड्स, फोर्थ है स्टोर ऑफ वेल्थ और वैल्यू इज पॉसिबल ओनली इन द फॉर्म ऑफ गुड्स, फिफ्थ है ट्रांसफर ऑफ वैल्यू इज कम्बरसम. अब है फंक्शंस ऑफ मनी, पहला है मीडियम ऑफ एक्सचेंज, दूसरा है मेजर ऑफ वैल्यू और यूनिट ऑफ अकाउंट, थर्ड है स्टैंडर्ड ऑफ डिफरेंट पेमेंट्स, फोर्थ है स्टोर ऑफ वैल्यू, फिफ्थ है ट्रांसफर ऑफ वैल्यू, सिक्स्थ है इट इज द बेसिस of other credit instruments. Um, seventh, it facilitates the study of national income distribution. Eighth, it is the barrier of option. Ninth, it serves as guarantee of solvency. Tenth, it facilitates the study of the concept of equilibrium in economics. Static functions of money, it refers to those functions of money which are fixed, technical, conventional and passive. Such functions only help to regulate the economic system and do not infuse any dynamism into the system. Our dynamic functions of the money, it refers to those functions of the money which impart dynamism to the economy. Here money is used as a means of ensuring stability of price level and improving the level of income and employment. Money supply, it refers to the quantity of money available in the economy. It is a stock concept measured at a point of time. There are two principal components of money supply. First, a currency, second, a demand deposits. Away monetary aggregates used in India. Old measures M1, M2, M3, M4, and new measures and M2 and M3, L1, L2, L3. Factors influencing money supply. पहला है size of monetary base, second है proportion of cash and demand deposits, third है velocity of circulation. अब है money multiplier, it is ratio of change in supply of money to the change in monetary base. High powered money, it is that money which is issued by the central bank and the government and kept by the public and the banks. A credit multiplier, it refers to the ratio of change in total deposits to change in primary deposits. Demand deposits, these are those deposits with the banks which the depositor can withdraw on demand by issuing a check. Primary deposits, the amount deposited in cash by the public in banks is called primary deposits. Derivative or secondary deposits, derivative deposit is the result of primary deposit because the bank creates secondary deposit by keeping a part of the primary deposit in reserve. Cash reserve ratio, the part of the total deposits which the bank are required to keep as cash reserves is called cash reserve ratio. Excess reserve, the amount lying with the bank in excess of the required cash reserve ratio is called excess reserves. About limitation of credit creation, first a cash reserve ratio, higher the cash reserve ratio, smaller will be the volume of credit creation. Second, amount of primary deposits, a higher deposits imply greater capacity to create credit. Third, banking habits of the people, strong banking habits implies larger transaction through banks offering greater opportunities of credit creation. Fourth, credit policy of the central bank, cheap credit policy facilitates greater creation of credit. Fifth, policy of other banks, credit creation capacity enhances if all banks function in unison. Sixth, confidence of depositors. Second, seventh, availability of good borrowers. Eighth, commercial and industrial conditions. There were two principal parameters that delimited the cash creation capacity of the commercial banks. पहला cash reserve of the commercial banks, second a cash reserve ratio is fixed by the central bank of the country. Money demand, it is the amount of money that people want to hold during a given period of time. अब factors influencing the demand for money, पहला wealth of the community, second है rate of interest, third है availability of credit, Fourth, expected income. Fifth, expectation of price change. Sixth, availability of substitute assets. Seventh, system of payment. System of cash payments enhances the demand for money. Eighth, instability of the capital markets, implying greater demand for cash reserves. Ninth, institutional factors including factors like political stability. Three motives of demand for money. पहला transactions motive, second precautionary motive, third speculative motive. Transactions demand for money. People's demand for money to handle their daily transactions is known as transactions demand for money. A precautionary demand for money. Their desire to hold money to encounter emergent situations is known as precautionary demand for money. With speculative demand for money, it refers to the money demand to speculate in bond and other assets where price and interest rate tend to vary. Liquidity preference, it means preference for cash holding. Monetary equilibrium, equilibrium of money demand and money supply is known as monetary equilibrium. Value of money, the amount of goods and services received in exchange for a unit of money is called value of money. Value of money and price level, value of money and its general price level are inversely relative, that is, value of money is inversely proportional to price level. Quantity theory of money, there is direct proportionate relationship between quantity of money and general price level, and inverse proportionate relationship between quantity of money and value of money. Fisher's equation is equal to Py is equal to mv plus m dash b dash, or P is equal to mv plus m dash b dash upon y. Assumptions of quantity theory of money. पहला constant velocity और constant v and v dash. Second है constant trade transactions. Third है full employment. Fourth है constant proportion between m and m dash. अब criticism, relationship between quantity of money price level is a simple truism. The theory is based on unrealistic assumptions. Third, variables incorporated in the model are deemed as independent but in fact are not. A lopsided theory as it focuses only on the supply of money, eschewing the demand side. Fifth, the theory wrongly construes price level as a passive factor. Sixth, the theory is applicable only in case of full employment. Seventh, it fails to explain trade cycles. Eighth, the theory reveals inconsistencies. Ninth, it ignores the significance of rate of interest. 10th, it is difficult to measure velocity of money. 11th, it ignores the non-monetary factors. 12th, prices may be the result of income level rather than the quantity of money. A Marshall equation. है m इज इक्वल टू के वाई प्लस के डैश ए, पीगुस इक्वेशन है के पी इज इक्वल टू के आर बाई एम, रॉबर्टसन्स इक्वेशन p इज इक्वल टू m by kt. Criticisms of Cambridge version of quantity theory of money. First, it is based on unreal assumption. It ignores the speculative demand for money. Third, it involves circular reasoning. Fourth, it is found to be an incomplete theory. Fifth, it ignores the effect of rate of interest. Sixth, it ignores the influence of real factors. Seventh, it fails to explain trade cycles. Eighth, it suffers from the lack of integration of theory of value and theory of money. अब एक Keynesian theory of money and prices. So long as there is unemployment in the economy, increase in the quantity of money causes interest. Once full employment is reached, increase in the quantity of money causes proportionate increase in prices. Keynes equation, n is equal to E by O plus I minus S by O. Superiority of Keynesian approach over quantity theory of money. First, it facilitates the integration of money theory with the theory of value. Second, it certainly is a more realistic theory. Third, it facilitates integration between monetary theory and theory of output. Fourth, it offers proper explanation of the causal process. Fifth, it serves as a much better guide to economic policies.